We're using a reverse purchase money loan to fully fund a purchase so a client does not have to pay all cash or get a traditional mortgage. Or we're staying in our existing home and we're using the reverse mortgage to pay off an existing loan and eliminate the mortgage payment. Or we have a free and clear home or a home with a small mortgage balance and we're using mostly the reverse credit line. And we are big believers under my leadership at Guaranteed Rate. I train everybody this way. Do not try to convince anyone to over leverage themselves. You know who it's good for the more money you borrow? Your lender. Would you folks rather sell $1 million house or a $100,000 house? Would we rather make $1 million loan or a $50,000 loan? Okay? This is a protected class of people. I counsel our clients and all of our salespeople and reverse specialists. Do not convince people to take money out and put it in the bank and accrue interest. Just leave it in the credit line growing for you. It's like cash. It's like cash with a return that's so much better than having it in a savings account or checking account. So, and by the way, with the federally insured loan from Uncle Sam, you know, I had I don't know if anyone's ever heard of SunTrust. I had a really nice credit line on my house years ago. When the financial crisis hit and I wanted to use my credit line, and guess what the bank said? We've changed our appetite. We don't want to extend that credit anymore. Well, let me tell you what happens with these loans. As Ernie and Rose go from 67 to 87, if their lender has gone out of business, Uncle Sam comes in and makes good on the commitments. Okay? You don't lose it. If you had a traditional HELOC and the company goes out of business or loses its appetite to extend the credit or says it's after 10 years, there's no more draw, the credit line's not growing, and now you have to make a payment, or now we're going to do another appraisal, we've lost our appetite, pay it off, okay? Doesn't happen with this. People can't take that risk as they age, okay? So how does HECM compare to conventional financing? Okay. There's an age restriction. Someone's got to be 62. You're allowed to have a non-borrowing spouse under 62 that's fully protected. That's all I'm going to say about that. We can talk about that offline, okay? But at least one borrower has to be 62. With conventional, there's no age restriction except the legal age of 18, okay? And technically, you can have a non-borrowing spouse down as low as the legal